Here is the 2 p.m. announcement. Initially, we went down. Now we're back up. A lot of times there are zigzags, including when Chair Powell takes a lectern at 2:30. What matters today is not only the close today, but also the close tomorrow. So you take yesterday's, that would be Tuesday's close. You compared it to tomorrow's close. If it's higher, well, that is a successful FOMC announcement, not necessarily from the perspective of the Fed, but from the average investor. Now, let's take a look at the sector action. Only tech in the forefront there. Notable because that has been a leading sector this year and one of the worst off last year's. And that kind of speaks to that paradigm that we've had where the NASDAQ is leading this year, leading the Dow, and it was the opposite last year. Energy taking up the rear there. But let's check out what's going on in the bond market. And not seeing a whole lot of movement here either. This is a 10-year Treasury note futures, basically where we were when we started the announcement. So I would expect that to pick up some steam when Powell takes some questions later on. And let's get to some other markets here, some other leading markets, especially in the futures. Let's take a look at gold. Gold really not moving. Now, gold has been on a little bit of a tear so far. It's up 5.5% year to date compared to where it's been over the last year, really regaining some of that lost territory. Copper futures, let me put this back to an intraday. Not seeing a whole lot of movement from Dr. Copper right there. And we got to check out Bitcoin. Bitcoin, very telling. I've been saying you want to know where the stocks are going to close. Watch where Bitcoin is moving into that press conference, and it looks very squiggly right here. That's because this is a very small range for Bitcoin. Let me put a year-to-date chart here, and you can just see what I'm talking about. It's pretty much flatlined over the last week to 10 days. So if Bitcoin starts moving up in a big way, that could be a leading indicator. Down the same way. Don't have much more than that. You know, we look into these statements and we look into the charts with quite the color dye here, Dave.
It's really hanging on, though, Bitcoin. Really just...
Above 23,000 still, above 20,000. Can't complain.
Kathy Wood this morning reiterating a base case of 500,000 by 2030. No less. Right? It's just about what you'd expect. Jared, thank you, my friend. Let's check in now with former Federal Reserve Board Special Advisor and Dartmouth College economics professor Andrew Levin. Nice to see you, sir. So we'll give you a blank slate there, your reaction to the expected 25-point hike and the language, ongoing increases. What are your thoughts?
Well, I think that there were a few minor updates to the statement that they issued at 2 o'clock. The quarter-point hike was no surprise at all. So the real challenge here is for Chair Powell in a few minutes to explain more about their thinking. There has been a lot of economic news in the last few weeks. So it's really important for him to give an update how their thinking is evolving since the last time they met in December. Remember, 4 times a year, the Fed issues a fresh set of economic projections, but this is not one of those 4 times. So it puts a little bit more weight on the remarks that he's going to make.
Well, Andrew, how has your thinking evolved since the last time we spoke? Because when we spoke then, you were saying 6 to 7% for the Fed's funds rate. That wasn't out of the question. Has that changed since we have gotten some economic data that has shown that the economy has eased a bit?
I think that there has been some good news, and so I'm trying to keep an open mind here, not to get struck in a rut. I think the good news is that some of the measures of inflation, and even the latest measure we got yesterday on the employment cost index, there's some sign that nominal wage growth might be starting to edge down. I think we need to wait several more months to see some more employment reports to get a clear handle on it. It's complicated because there's a lot of different kinds of workers, and the workers who are coming back into the workforce. We saw it this morning in the latest, it's called the JOLTS report. Still a lot of workers quitting their jobs, moving to a different job, probably because they want a cost of living increase and they couldn't get it from their previous employer. So the challenge for the Fed is that if workers continue to want to get cost of living increases for the big cost of living increases they've faced in the last couple of years, firms are under pressure in a strong labor market to do that. Firms got to pass those costs on to into their prices. Then we see kind of inflation getting entrenched. And so I wouldn't rule out the possibility that the Fed still needs to raise further. But I think probably the latest data gives them some breathing room. Maybe they'll make one more quarter-point hike in March, and then maybe they can wait a few months to sort of see, is the service price inflation coming down the way they've been hoping, or is it staying too high and that they need to tighten a bit further to really make sure that inflation comes back to earth?
So we're about 10 minutes away from the most measured speech since Tom Brady's retirement this morning. What are you listening for, Andrew?
Well, I think that some investors have been really worried about the risk of a recession. The latest consumer data we got for December doesn't look so great. The distinction of is the economy just flattening out, kind of taking a pause, but it's going to pick up speed again, or does it look like it's teetering on the edge? And so I'm sure that Chair Powell is going to get questions about this today. Kind of what do Fed officials see as the risk that the economy is going to slide into recession, and how is that influencing their policy plans? Those are going to be really important questions for him to address.
What do you think about the likelihood of a recession in 23?
I'm hopeful that that's not in the cards. The disposable income's actually been pretty strong, and that's of course helped as workers get cost of living increases, gives them some buffer. Another good news about the inflation that we saw in some parts of the economy has definitely subsided. And the rent prices are starting to show some signs of slowing down. So consumers get some breathing room on the cost of living, then that means that the income increases they get will go further. So hopefully people call it a smooth landing. I was a little bit skeptical about that a few months ago. I think there is some more positive signs. So one good case for the Fed is smooth landing and inflation continues coming down, and the workers have enough cost of living increases that wage costs start to flatten out. Bad cases for the Fed, which are still possible, is the economy slows a lot, but workers are still getting hefty cost of living increases and inflation's still stubbornly high. Then the Fed has to make some tough decisions.
Yeah, Andrew, let's talk a little bit more about the labor market and the dynamics at play there, because I think everyone's been scratching their heads trying to figure out the fact that it has been so resilient, what that signals in terms of what's ahead, if it in fact will ever break. And some Fed officials have voiced concern that prices could potentially reaccelerate because the labor market is so tight. How valid do you think those concerns are at this point in the economic cycle?
Okay, I mean, these are really great questions, and again, we'll look to Chair Powell to see what he's thinking. But what I would say is, first of all, we look at the weekly jobless claim numbers coming in week by week, and those are still very, very low. So there's lots of headlines about a few high-tech firms that are laying off workers, but for most of the economy, particularly in the service sector, they're desperate to hire. And in fact, this morning's report, the job openings went back up again. So a key distinction here in the economy is residential construction's lousy. The housing sector got hit really hard by the increase in mortgage rates. Manufacturing sector is facing some challenges. The service sector, they're looking for more workers, and that's where they need to give cost of living increases. And that's where the labor costs are a big part of the prices that those firms charge. So I would say that the labor market's strong. It's not overheated. And that's an important distinction. It means the Fed doesn't necessarily have to hit the brakes. If the cost of living increases can slow down a little bit as workers are catching up, then maybe this will all work out fine. The much harder situation is the one where inflation's still running 2 or 3 times the Fed's target. The Fed may have to do more.
To your point, these layoffs have mainly been isolated to the tech sector. We got some more news today out of the automobile sector. Other than Hasbro and 3M, maybe a handful of names, it has been where that's really just 2% of our workforce. Do you think they will begin to spread in the months ahead to the economy as a whole?
Again, I hope not. I will point out that Walmart, which is a huge employer, just announced a few days ago really big cost of living increases, which I think is great. The people who work at Walmart deserve to get a decent pay. But those pay increases are on the order of 10, 15, and 20% for these hourly workers who used to get paid $12. Now they're going to get $14 an hour. It's still, these are not greedy workers here. They're just getting a fair pay, okay? But the point is, Walmart is a sign of the service sector of the economy. The hospital workers, there's a lot of other workers who've had really big cost increases in their cost of living. They have to tighten their belts. And those workers should be able to get cost of living increases. That creates the challenges we're talking about with these wage price dynamics.
Andrew, what is your read on the consumer? Because the retail sales, they pulled back over the last couple of reports that we've gotten, down 3 of the last 4 reports. We've gotten some data out from Citi this morning of their credit card data showing that overall spending is at its weakest point that it's been since April 2020. How big of how material of a pullback are you seeing in the consumer data and what that signals?
Well, one of the challenges with this data is in normal times, when the economy is kind of humming along, we see normal seasonal patterns. So usually in the past, the consumer spending was very strong in November and early December in the lead up to the holidays. I think part of what happened last fall, for a number of different reasons, was a lot of that consumer spending happened in October and early November. Another shift that's been happening lately is people spending less on goods and more on services. So these things make the data more complex to read and more complex to interpret. As I said before, the consumer data definitely has shown some signs of faltering, but with disposable income remaining strong, I think there is a reasonable hope that consumer spending will be resilient this year, and that we're not that close to the edge of a cliff.
All right, we're going to have to leave it there. Andrew Levin, we much appreciate your analysis, sir. We are awaiting the words of Jerome Powell, the Fed chairman. We will take him live as soon as he begins to speak. Let's check on the markets and how they're reacting to the increase, the 8th in a year, and the language. Again, it's ongoing increases. Look at the Dow, down 320 points. Is that a session low, or right near it at least? You see the NASDAQ continuing to outperform, up, albeit very slightly, and the S&P also down just marginally. What are you looking forward to hearing? I feel as though, look, I'm going to play this game because I think it really is intentional that he used the same language as he did in March related to ongoing increases, leaving us to believe there is more than one after this, which I happen to believe there is another one this year. Yeah, increases. It signals at least 2 more, so it'll be interesting to see any more commentary on that from Powell. I also think, just in terms of the fact that a lot of these changes, what a couple of our guests have been saying,